Hey, Bill Lethman here for Money Evolution. In today's video, I'm going to be taking another deep dive into helping you to create your retirement tax and withdrawal strategy. Now, I did a video a few days ago down in my studio where I actually put this all up on the whiteboard and I went through a lot of math just so you could kind of see some of the rationale and some of the processes that go into developing this strategy for not only how you're going to get enough money out to cover your living expenses in retirement, but how you can take those withdrawals and do it in the most tax efficient way. So in this video, we're going to be going into our eMoney advanced financial planning software and actually showing you kind of the easy way to put this whole thing together. And we're going to be looking at a couple of different things. Anytime we're putting together a retirement plan, the number one goal always is to get a retirement that makes sense for you. So you can do all of the stuff that you want to do in retirement. And I think oftentimes when you watch a lot of videos that may be up on YouTube, they start talking about Roth conversions and some of these heavy tax strategies, but they're forgetting one very important element, and that is, well, you still have to live. You still have to take some money out of your portfolio to cover all the things you want to do in retirement. And that's really the most important part of this entire financial planning process. But in doing that, there is going to be an efficient way to do this. There's going to be a right way to take that money and which accounts to withdraw from first and in what order and how you can kind of position this within some of the different guidelines inside the IRS tax code. So in today's video, we're going to be looking at this and we're going to be looking at a couple of things. Number one, we're going to be talking about the 0% long-term capital gain tax bracket and showing how you can take the right types of withdrawals at the right time in your retirement planning to actually pay zero federal taxes on those withdrawals if you're coming from a taxable non-retirement account and it capitalize on that long-term capital gain 0% tax bracket. We're also going to be talking about Roth conversions and seeing if that's something that can get money transitioned effectively, asset shifting money from traditional retirement accounts over to Roth, and is that going to be able to save us some money long term? And then the third thing we're going to be talking about here is we're going to be taking a look and exploring whether or not this hypothetical client of ours can actually qualify for an ACA subsidy. So according to the Kaiser Family Foundation, which does a lot of really great research on all things healthcare related, they actually estimate that a 60-year-old couple going into the ACA exchanges on an ACA silver plan would expect to pay about $30,000 a year for those premiums from 60 until they're eligible for Medicare at age 65. So that is a huge number. If you could qualify for an ACA subsidy, even at that top tier of that ACA subsidy, which has to have your income below about $84,500, you could actually reduce that from about $30,000 down to about $11,000, so a $19,000 savings. So we're going to hop over into our financial planning software. We're going to be looking at Andrew and Michelle Harrington here. And the first report that we have up on our screen is the cash flow report. And that is really the centerpiece of our entire financial planning process. And again, the first thing that we want to make sure is that the Harringtons or you or whoever is doing this financial plan is going to have enough money to do all of the stuff that they want to do in retirement. And we can see that pretty clearly from this report right here. The most important report in the whole entire financial planning process is this portfolio assets, and that's showing that their assets are still increasing a little bit over time. And we have some pretty conservative growth rates in our model here. We use 5.09% for the growth of the portfolio. And the reason why we tend to be a little bit more conservative with these growth rates is because we want to account for the sequencing of returns, that some years are going to be much better returns and some years may be negative returns as the markets are going through those cycles. So using a low assumption there gives us a little bit of a fighting chance that we're not going to have that sequence of returns knock us into a bad position here. So we can see the Harringtons, they have about $5 million of investable assets, and that's going to be split between some non-retirement accounts that they have some capital gains embedded in a brokerage account, and then the bulk of their savings is going to be in a traditional retirement account. I think they have a little bit of money in Roth, and we can see this all broken down if we look at a report that's called assets by tax type here. And we can see that. And that's going to be very important. That's probably one of the most important parts of this process is to not only make sure that you get your cash flow straight and you know how much money you're going to be withdrawing, what those gaps are, but also where that money is, because ultimately when we're creating this retirement tax and withdrawal strategy, we're going to be effectively drawing from those buckets. And we have a choice in retirement. And that's something we really probably didn't have much of a choice of while we were working. When we were working, we made some money and it was reported on our income statements and our tax return, and we paid taxes on that money, and we didn't have quite the flexibility in this whole process like we do in retirement here. They do have a little bit of some money that's in a cash reserve here, but the bulk of that taxable asset bucket right here is going to be in a brokerage account. They have about $1.4 million of assets in there, and they have $1 million cost basis, which means if they sold the whole thing, they would have to pay a capital gain tax of $400,000 on that money. But what we want to look at here is a couple of things. Number one is we want to see, is it even possible for us to be able to get that ACA subsidy? Is that something we should even be thinking of? And everyone's situation is going to be a little different, but I'll tell you the one thing that is going to help that situation and your ability to get that ACA subsidy is if you do have some monies outside of your traditional retirement accounts that you can draw from in those early years of retirement, and you can keep your income tax below that $84,500, which is that ACA subsidy limit. If you can do that, then it can really save a lot of money. And for the Harringtons, for example, they're going to save potentially, if they can qualify for this, about $120,000 in ACA premiums. So what we're looking at here is Andrew is actually 60 years old and Michelle is 58 years old. So we have 5 years of having to go out into those exchanges for Andrew, and we have 7 years that we'd have to go out into those exchanges for Michelle there. So that's our window there. And so the first thing we want to do is we want to get an idea of where some of their long-term tax brackets are, so we can see what are some of those potential issues that could be coming up down the road. The biggest one of those is going to be your required minimum distributions. So depending on how much money you're withdrawing from your accounts and what other monies you have available and what the growth of those assets are going to be between now and age 73 or age 75, that's when those RMDs are going to begin, depending on what year you were born. If that money that you have in those traditional retirement accounts is going to be too much, it could force out some bigger RMDs. And not only could that push you up into a higher tax bracket, but it could also mean IRMAA, which is the income related monthly adjustment amount. That could mean your Medicare benefits could also go up as well. And depending on how much money you have in those traditional buckets, it could even effectively double your Medicare costs, or even in some cases, if you have really a ton of money in those, it could even triple your cost for Medicare there. So we can kind of scroll down, and I think this is one of the most valuable pieces of this financial planning software, and something that even your accountant probably doesn't have this kind of insight into what your future taxes are, because they probably haven't gone through and done the financial planning that really can take into account the growth of the portfolio, the withdrawals, Social Security benefits, all of the different things that are happening inside your plan here to be able to give you that ability to see not only what your taxes are now or over the next couple of years, but what does that look like down the road. So like a lot of our clients, we have what we call sometimes these low tax years in the early part of retirement. That's something we definitely want to capitalize on. And we can do that in a couple of different ways. One of those is to do some Roth conversions to take advantage of those low tax years. The other one is if we do have money in those non-retirement account assets, we could use that as an opportunity to basically eliminate some of that capital gain. And that's always going to typically be the most efficient way to withdraw our assets, to take that money from those non-retirement accounts first, and then if we do have room in the bracket, to go ahead and do those Roth conversions. So we can see that they're actually going to be in a fairly low tax bracket, a 10% bracket here for the first almost 10 years of retirement, and then it does jump up to 22%, and then later on, as those RMDs really start to get away from us a little bit, we can see those RMDs are actually pushing them up into a 24% tax bracket. One thing that is represented here, and I've talked about it in other videos, is something some people refer to as the widow's tax penalty. And what that is if you think about the money that's in your traditional retirement accounts, at age 73 or 75, you're going to have to start taking mandatory distributions from those accounts. And you might have an IRA and a 401k. Maybe your spouse also has an IRA and a 401k. And if you pass away, your retirement assets are probably going to pass along to your spouse. That's what probably most people are going to do. Well, they're going to have all of that money in their IRA account, and they're going to have to take an RMD based on that balance. And the RMD is probably not going to be too much different for a married couple than it was or for a single person as it was when you were married. But the one thing that will change is you're going to switch from a joint tax return to a single tax return. And what that's going to mean effectively is you're going to have higher levels of taxation at lower levels of income. And if you look at the first couple of tax brackets, basically the married filing joint tax tables are about double what they are for a single individual. So we can see that for the Harringtons here, if something does happen to one of them, they could jump up all the way into a 32% tax bracket there. So I've already illustrated a number of these things out. We can also look at our income tax report, and we can see a little bit of what's happening. And these are going to just be the default things that are built into the plan. So we can see regular federal income taxes for the first number of years in retirement is effectively going to be zero. And that's because the amount that they need to withdraw from their portfolio to meet their cash flow gaps is less than what their capital gains are going to be needing to taking out from that non-retirement account there. But if we kind of dive into this, we can see a couple of things here that even though they may be in a 0% tax bracket from federal tax returns, we can look at this adjusted gross income column and we can see that those numbers are getting up a little bit too high, at least in terms of being able to qualify for an ACA subsidy there. So the ACA subsidy, like I said, needs to keep your income, at least right now for 2025 and 2026, about $84,500 is that number. The only thing that's going to really be different from adjusted gross income to modified adjusted gross income is if you have any tax-free interest from things like municipal bonds or any foreign earned income credits, those get added back into your adjusted gross income for the purposes of that modified adjusted gross income, and that's the benchmark. So that's before all of your deductions and everything go out of this. So that's the number where we need to get this column right here to get under that $84,500. So even though they're paying zero taxes, they are still going to be too high of an income effectively to get that ACA subsidy there. By the way, just to give you an idea, so that long-term capital gain tax bracket is $96,700, and if you add in your standard deduction, for example, $32,200 for 2026, or I think it's $31,500 I think for 2025. If you add that together, that gives you about $128,000, $129,000 of long-term capital gain that you could effectively pay 0% tax on. So one more thing I want to explain on that, just to kind of make this point a little bit more clear. So if you had $200,000 worth of a stock that had a $100,000 cost basis, if you sold all $200,000 of that stock, your taxable long-term capital gain, if it's held for longer than 12 months, would be $100,000. So you're effectively able to remove $200,000 worth of that stock to go and cover some of your living expenses in retirement or refill your cash bucket, whatever that may be. But you're only having $100,000 of that showing up on your tax return. So again, the Harringtons have $1,400,000 in their non-retirement account asset that's got a $1 million cost basis. So if they sold it all, they would only have to pay that long-term capital gain tax on that $400,000. It would be reportable. But we don't want to do that all in one year. We want to kind of stretch this out a little bit here. So the first thing we did is I did a couple of different scenarios here. And one of those is where we looked at doing an ACA subsidy and also planning out some future Roth conversions to see if that's going to give us a little bit of an advantage here. And what we can see is that when we look at this adjusted gross income, by piecemealing out that non-retirement account and selling a little bit of that every year, being careful to stay under that ACA subsidy level, we're able to do a couple of things. Number one, we're still staying in that 0% tax bracket for long-term capital gains, but we're also keeping that adjusted gross income right around or below what that ACA subsidy is going to be. So again, that's going to give us an improvement of about $19,000 per year in terms of savings and expenses, saving on those ACA premiums there. Now, we don't know what that level is going to be for those ACA subsidies in the future years. It's going to be something tied to the federal poverty level, and it's going to be where the basically when the ACA subsidies end is going to be at 400% of that ACA subsidy or 400% of that federal poverty level, I should say there. There has been a lot of discussion here because the One Big Beautiful Bill passed in July of this year in 2025, and one of the things that it did not address is it did not extend those ACA subsidies. So effectively, during COVID, they passed some legislation that gave us an ability to extend those subsidies even beyond that 400% level. And what they did effectively was they capped that your ACA premiums at 8.5% of your modified adjusted gross income. So it used to be that even if you were over those levels, you could still continue to get some subsidy, it would just be at a reduced amount, but now it's going to be more of a cliff. So if you're even $1 over, that subsidy completely goes away there. So this is great. So we're staying under that ACA subsidy. We're staying in that 0% long-term capital gain tax bracket. And we look at what the outcome of this is. We can look at this in a couple of key metrics areas here. And what we're going to do is we're going to look at that in terms of, did it save us any money in taxes over the long run? And did it improve our long-term portfolio assets over the course of the plan here? And so we can see that in fact it does. It saves a little bit of taxes here, $90,000 in tax savings by doing that ACA subsidy strategy to keep that 0% long-term capital gain tax and stay under that $84,500, as well as putting in some Roth conversions. So effectively, the Mitchells, or the Harringtons, I should say. Mitchells is another one of our hypothetical clients there. But the Harringtons, they have to basically get this subsidy for 5 years for Andrew, and it's going to be 7 years for Michelle, basically because, again, they're 2 years different in age there. So we can see that saves $90,000 in taxes and actually increases their portfolio assets by almost $1 million. And I'll take a look, because there's even a better reason for that just than that, because it's going to be where that money is at, not just how much money there is there. So that's really good. They still are going to stay in a very low tax bracket. In fact, it's going to be effectively zero for those first 5 or 7 years or so. And then we're going to start to really knock down and aggressively tackle doing some Roth conversions to bring down that value, that amount that's in those traditional retirement accounts, so that it doesn't become a problem later when those required minimum distributions kick in there. We do show this going a little bit into that 24% tax bracket. This is something that, again, we don't know what the tax brackets are going to be out in 2036 or what kind of legislation may come out there, but this is something that can be dialed in on an annual basis. This is just the easy way to do it inside the software here, but in reality, we do want to probably stay under that level. But remember, it's a progressive tax system, which means that if we do go over, for example, by about $20,000 like we have here in 2036, it's only going to be that 24% bracket on that $20,000 that we exceed that by. So that's something to keep in mind there. And as we're looking at the tax brackets too, everyone's going to be a little bit different there. You know, sometimes, you know, if you're at a different level, you may be targeting more like a 12% bracket, but that jump from 12 to the next bracket goes up from 12 to 22. So that's a 10% increase in that bracket. So if you start going well over that, that's a big deal. If you go from 22 to 24, not so much. A couple of percents, maybe not that big of a deal. If you go from 24 and you exceed that, it's going to jump all the way up to 32%. So there's another big jump there. So you always want to be looking at, where are you in the tax bracket? How much room do you have? And what is that next bracket? And always be looking ahead and having that roadmap so you can see, okay, I know where my taxes are today, but what is that going to be in a couple of years? And always kind of have that looking out into the future to make sure there's not that much of an issue there with that. So we can see there's definitely some very good advantages with that. When we look at the breakdown of those assets, we can also see a pretty nice differential here with that ACA subsidy versus our base plan. And we can see that you know, our base plan is going to be this one on the right, and effectively, if you don't do any of those Roth conversions, you're going to still end up with the bulk of your money in those traditional retirement accounts. And that's not only going to be a problem for you as you take money from your retirement accounts, or as maybe you have a big item, maybe you want to take the whole family on a big trip, or you want to buy a sailboat, and you want to take a big withdrawal because your accounts have done well. Well, anytime you take money out of that traditional tax-deferred retirement account, you're going to be paying taxes on that. It's going to push you up into whatever tax bracket that is. The other thing we can see here without doing those Roth conversions is because our RMDs are actually going to be bigger than the required or your necessary withdrawals just to cover your living expenses, those non-retirement account assets that are taxable every year if you make gains or interest or dividends, whatever that may be, that is increasing that taxable portion of your portfolio because of that. Now, with doing those Roth conversions and then coupling that with this ACA subsidy strategy and everything, we basically have drastically reduced the amount in that traditional bucket, and we've also drastically increased the amount that's in that Roth bucket. So when we look at this all the way down here, we run this out to age 95, we have a lot more money, about $1 million more in that strategy where we map this out a little bit better. So we have 7.2 million versus 6.2, but it's even better than that because in the no Roth conversion strategy, there's still 3.7 million that's in that traditional bucket. And when that passes on to your kids or to your heirs, your beneficiaries, that's going to be taxable to them. And they're going to have a window of 10 years under the current tax rules to distribute that money out over a 10-year period. And depending on if it's one person inheriting all that or it's two people or three people, that's something that would go and get added on to whatever other income they have. And there's a lot of taxes that would likely be due as a result of that. But we've basically transition that, and there's only $781,000 in that traditional bucket. So we didn't completely eliminate it. Sometimes we do. It depends on the strategy. But generally what we did here and seeing that traditional retirement account just kind of drifting down is kind of the strategy that we want. Sometimes people might advocate for doing Roth conversions a lot more aggressively, and it ends up where all their money or the bulk of their money is in that Roth bucket much earlier. But I like to kind of smooth it out. I don't like to necessarily push us up into a higher tax bracket in the short term, and it doesn't really give us the long-term benefits of that. So that's basically where we want to come out with that. And if we look back and we go back to our cash flow report, we can also see what that's done for our required minimum distributions. And that's going to be shown here on our cash flow report. And so when we look at our base facts without doing this ACA strategy or the Roth conversion strategy, we can see that their required minimum distribution age is going to be 75. If you were born in 1960 or later, it's 75. And if you were born before 1960, it's going to be age 73. But once they're both getting their RMDs, it's going to be $250,000. It's going to be forced to come out of those traditional retirement accounts. And that just continues to grow. And again, we've used some relatively conservative growth rates here in our modeling. But if instead of getting a 5% return, you got a 6% or 7%, well, those numbers are just going to get even higher and bigger there. But we can see what that looks like. Now, so we peaked out, just to kind of take a mental note here, right in that 400, 450 range. It does get up to 472 is the highest. But with our strategy that we're outlining here, we can see that that is going to be dramatically reduced. And so the highest it ever gets up to is about $170,000. So that's a big difference. And it's giving you a lot more control over the distribution of those assets. Like I said, if you start doing well with your portfolio or something changes in your life or you want to have the ability to take a bigger withdrawal one year, having that Roth bucket is something that I sometimes refer to as tax diversification. Because with that traditional bucket, if you have the bulk of your assets in there, every time you take that distribution, it's going to be taxable, and you're always going to be looking at the tax bracket. But, hey, I want to we're going to buy a big, sailboat. We're going to spend $200,000 on a boat. We're going to take that out of the Roth, and that's not going to push you up into a higher tax bracket there. So I hope this gives you a little bit of an idea of how we start to think about this, and having a tool like this that can really map this out, not just in seeing if your retirement's on the right track. That is the number one part of this whole financial planning, retirement planning process, is to map this out. We can look at this, and then you can change up your spending. We can add in variable expenses. I think even in this plan here, we put in some future weddings for their kids that are in here that we just put as placeholders. Maybe you don't know when your kids are getting married yet, but you want to say, hey, I'm going to budget a certain amount for their wedding, and let's just put that out into the future, maybe in 2030 or 2032, and we can put that as a place marker. And as it gets closer, as the wedding actually gets scheduled, and when that expense is coming up, you can move that around inside the plan. And again, if you have $100,000 budgeted for a wedding, and that's coming up in the next year or two, it's good to know that in advance, because again, that's going to go into where's that money coming from? Which account do I have to take that from? And is that pushing me up into a higher tax bracket? And we've dealt with this several times just over the last few months with clients that are planning weddings or planning big purchases, sort of looking at that and saying, hey, maybe if that's going to be the expense we have for 2026, maybe we don't want to take that all next year, maybe you want to take part of it this year, and then we'll take the rest of it next year so that it's not pushing you up into a higher tax bracket. So anyway, that's how we do this, retirement tax and withdrawal strategy. And there's a lot of things, a lot of moving parts to this. And I hope this has been helpful to give you an idea of exactly how we put these things together. I'm Bill Lethman, moneyevolution.com. And if you'd like to learn how we can help you put together a plan for your retirement that looks like this, we have a program called the Retirement Time Machine, and it goes through the exact steps that we're outlining here today. And if you want to learn more about that, you can go to retirementtimemachine.com, and we'll put some links to all of this stuff down in the description below. Thanks, and I'll see you back in one of our next videos.